Kitco Mining special coverage of the Deutsche Goldmesse is brought to you by Dynacor.
Gold's flying start to 2024. This is Paul Harris of Kitco Mining at the Deutsche Goldmesse conference in Frankfurt in Germany. And joining me today to discuss this is Brien Lundin, editor of the Gold newsletter. Brien, welcome back to Kitco.
Great to be here as usual. Thank you.
Well, thank you very much, Brien. Now, we are 18 weeks into 2024, and what a year has been in the gold space so far, and the copper, to be frank. The gold price has remained firmly above $2,000 per ounce, testing $2,400 per ounce. Gold producers are reporting their first quarter and beginning to show margin expansion and juicy cash flow. M&A is picking up as well. Why has everything suddenly turned so positive?
Well, not everything has turned so positive because I think there's a general disappointment from investors by the performance in the equities. And one of the things that I have been showing my presentations is that the gold equities have been actually leveraging this move in gold, but not quite as much as we would have liked. There are a lot of reasons for that, but the reasons why the metals themselves are performing so well, I think there's a growing unease in the marketplace or globally about the macroeconomic situation. This move in the metals has been shocking and surprising and have people really fighting and searching to try and find the factors behind it. And I think that we've largely identified a number of those. We've had central bank buying, we had buying from China, both from the PBOC and domestic Chinese have been big drivers. We've had expanding volumes on the COMEX. We have not had Western investors participating in the ETF market, which has been very interesting. And we've had some over-the-counter futures buying globally that have contributed. But I think there's more. I think there's still more out there that's driving this because the buying has been so strong and it's been against the current, as it were, with rising yields, strong dollar, seemingly to even help gold. Instead of being a bearish factor. So there's something more going on where you see big money moving into the sector, and I think it's for the general macro picture out there that there's too much debt in the world, not just U.S.-centric, but I think globally there's too much debt in the world, and that debt is not manageable with interest rates at current levels. So the broad picture is that there will have to be cuts in interest rates globally, not just the Fed pivoting, but the Fed will eventually pivot and we will eventually get a lower interest rate environment. One way or the other, actually, we'll either have a lower interest rate environment because central banks are in control and lowering rates because the debt service loads are so high, or we're going to go in the opposite direction and rates will rise and get out of control of the central banks because investors will demand a much higher return for the commensurate risk.
Okay, well, let's dig into some of those points a little bit more, Brien. The World Gold Council this week said that global gold demand in the first quarter to March was up 3% year on year to 1,238 tons, making the strongest first quarter since 2016. And within that, central bank demand was 296 tons, which the World Gold Council said was the strongest start to any year on record. So it seems there's, as you say, a lot of strong buying coming from a lot of strong hands. Yeah. I think at the start of the year, people were forecasting $2,300 per ounce gold by the end of the year. So we're hitting that 8 to 9 months early, and that's without the Fed actually cutting interest rates, as you said. So it seems the gold sector got fed up waiting for the Fed to cut and is taking action on its own. So I guess one of the key questions is the Fed pivot priced into gold or not yet?
Yeah, I don't think it is, but I think, as I mentioned, there's growing unease globally. There's big money shifting allocations toward gold, and I think that's in recognition of the macro factors that will eventually force the Fed to pivot. But we entered the year expecting a Fed pivot to be the big catalyst, as you say, drive gold over $2,300 by the end of the year. We saw in December of last year, gold actually reached an all-time high, kind of on the sly. Nobody really recognized it over the holiday period, but what was happening at that point was the market was pricing in 5 or 6 rate cuts this year. And then we got into the new year, everyone expecting that seasonal uptrend in the metals and the mining stocks, and it just didn't happen. And at the same time, Fed rhetoric started to shift and the narrative started to shift more toward the dot plot predictions of 3 rate hikes this year. And as time has gone on, we've seen those expectations and the narrative shift towards possibly no rate cuts this year because the U.S. economy has remained very robust. Inflation has remained stickier and frustratingly stickier than the Fed anticipated or anyone had anticipated largely. So that narrative of Fed rate cuts and a pivot this year has largely evaporated. If the market had priced in that pivot, you would have expected that premium to have also evaporated. So I think that it's not really, I mean, a large part of the buying has been hot money. We've seen volumes expand on the COMEX, especially amongst managed money hedge funds. We've seen some over-the-counter options trades globally that have helped drive gold. But I think there's a longer-term shift in allocations, stronger hands shifting to gold because of the broader macro picture developing that will eventually force the Fed and other central banks to pivot. But I don't think the actual event, that catalyst, has been priced in yet. So the good news for gold bugs is we still have that ahead, and we've already added $300 or more to the gold price in the meantime.
It does seem to be a setup where, the gold price has moved, the Fed hasn't pivoted yet, so the Fed pivot is still to come. So it does seem you don't need a PhD in technical analysis to see this trade and take advantage of it.
Yeah, and it's fundamental. It really is. You look at I see everybody's technical analysis, and everybody said that gold got overbought, and as we speak, it's kind of stalled and come back a bit. And the technical analysts are looking at that, and they're labeling it the B, C, D, E decline, and this is expected, and this is where we're going to go down, and we're going to erase a lot of the gains we've had this year. But I think that assumes that, it's what the charts may show, but I think, and this is a dangerous phrase to use in investing, I think this time is different. I think that, I may come to regret that.
Well, you're giving us a headline.
Yeah. That money is moving into gold for bigger reasons and more fundamental reasons. And again, we're at the end of what I've shown in my presentation to be a 4-decade plus trend of ever easier money, ever lower interest rates. And then in reaction to crises and recessions, we've seen not only lowering of interest rates by central banks, but extraordinary measures like in the great financial crisis, going to zero interest rates, quantitative easing, TARP and all of that. And then in COVID, all of that to a much greater degree. So it's successive cycles of ever easier money, and these cycles of that trend has a logical end point or end game. I think we're in the ending process of that trend. We don't know whether that's going to last 3 years, 5 years, 10 years, 20 years. But money is shifting toward gold because I think fiat currencies and a lot of financial assets are proving to be more ephemeral, and that these trends of depreciation are set to accelerate, and that the debt that has been built up over these many years of ever easier money is incompatible with interest rates that are above the rate of inflation. So the environment is shifting more toward from financial assets toward things, commodities, real assets, tangible assets, and of course gold is foremost among those.
Okay, let's follow the bull scenario. We've touched on $2,400 per ounce. Where do you think gold could get to? What's the sort of next upper resistance level?
Yeah,
people should watch out for.
One of the old saws of punditry is give a price or a time, but never both at the same time. And And so I don't know when we're going to peak in this cycle, but I think it's a longer term cycle unless things get really dramatic. I think we're looking at a 3, 5, or as we were in the 2000s, even an 11-year cycle as all of this gets resolved. But if you look at the history of gold, now obviously gold has been around as money for 5 millennia or so, but it's only been around as an investable asset, or at least not thought as money in the mainstream since 1971. So we are about 53 years of history of gold as an investable asset in the mainstream consensus. The only investment class younger than gold is Bitcoin or crypto. But over that 5-decade or so history, I at least divided into 3 bull markets: the early 70s, the late 70s, and the 2000s. And in those periods, from trough to peak, we saw that gold went up anywhere from 5.5 to 8 and some change times in value over those periods. I look at the bottom in this cycle it being around $1,040 on the gold price. And if that was the bottom, and we typically go up between 5 and 8 times, then that, I think, gives you your upside target for this run.
Okay, that's quite a big number. Let's be contrarian for a moment, though, Brien. The year started so well. What could go wrong?
What could go wrong? I think we have to look at the fact that maybe gold has priced in a pivot. Maybe gold is a predictive market. It is a predictive market. I think it's the most predictive of markets, gold and bonds. And so maybe it did price in the pivot. I don't think it has, but I think you always have to look at the downside. You know, I look back in history, and in 2011, the Fed came out with infinite quantitative easing. Instead of saying this is QE 1, 2, or 3, they said this is QE infinity. We are going to enact QE until and as much as we need to get the desired results. You would think that would be the most bullish pronouncement that would be possible for gold. But instead, that would mark the peak of the gold price. And I think at that point, what a lot of the traders involved in the gold price were looking at is that the next announcement, the next big event would be the end of QE. So therefore, they got out of the trade at the top because, you know, the anticipated event that they were trading upon happened. So I think that's a risk, that when the Fed pivots, it actually marks a high in the gold price. Again, though, I look at that long trend of ever easier money, and I think that has to reach a resolution at some point. I think it reaches a resolution that involves gold at some point, timing being the biggest question in my mind. So I think with that in the background, it's not likely that a pivot will mark the high in gold, but I think it's something we have to recognize as a risk.
It does seem that there's a lot of buying that's motivated not for investment reasons. Looking at the World Gold Council figures I just quoted, I think you could say 25 to 30% of that is from the central banks. Yeah. They're not buying for investment reasons. They're buying because they don't want to hold US dollars or US treasuries. Yeah. So, non-investment reasons, they just want something else other than greenbacks.
Yeah, if you look at the trend in central bank buying, I mean, in 2022, it reached an all-time record. 2023 was just a tad behind that, but still very heavy buying by the central banks. It all started right about the time that the U.S. issued those severe sanctions on Russia for the invasion of Ukraine. That essentially was weaponization of the dollar. And I think that central banks, both allies and foes of the U.S., are shifting toward gold as what it's always served. For the purpose that it's always served is independence of whatever financial regime is existing at the time. So I think that is a valid argument, and I think it's fairly obvious that's why a lot of central banks are buying gold. I don't think that inevitably or imminently leads toward the loss of the dollar status as the global reserve currency. I think that's a trend that will outlast you and I, or at least our practical investing horizons. I don't think that's going to go away anytime soon.
Okay, Brien, let's pivot. The gold price may be riding high, but as you mentioned earlier, most gold equities are stubbornly refusing to budge much. Why do you think that is?
I think there's two reasons behind it. One is that the rally was unforeseen because the rhetoric had shifted bearishly, actually. So the rally was fast, it was extreme, it was stunning, and investors naturally pulled back and thought, well, I'm gonna wait for the dip, wait for the pause, and then get in. And for the first 6 weeks of this rally, there was no pause, it was just relentless. So they were just waiting and waiting on the sidelines for an entry point. I think the other thing is that they didn't really understand why. And that, again, I think there's still a bit of mystery into what the precipitating factors were. So if you don't understand what's driving the rally, you don't have a good feeling for how long it's going to last. Now, if U.S. had entered recession, or there was some type of financial event that the Fed was reacting to, like the great financial crisis or COVID or something else, where you could see a couple of years ahead of monetary easing, then I think people would have just jumped in head first. But right now, there's again that mystery as to what's really driving the gold price, what the reasons behind it are. And therefore, people don't have confidence that it's going to stick around. And once that becomes more clear, and once we remain at these elevated stages, and I think if we stay around 2,300 for some period of time, then and show a resistance to falling back, I think you'll see more investment in mining and mining equities from the majors, and then filtering on down, because the majors are starting to produce financials that will show bottom line cash flow, and the market can only ignore that for so long.
And I think an increasing number of the bigger gold companies, they're tying their dividend policies to a percentage of free cash flow, or a base dividend with a percentage of free cash flow top up, depending on what that is. So the potential dividend payouts, assuming margin expansion, should increase, which presumably will be more appealing to some investors and get them in at the sort of the top tier, the bigger companies.
Yeah.
And then sort of trickle downwards.
Yeah, that's a big part of it. Typically, investors invest in mining stocks for the capital appreciation, and because there wasn't an awful lot of that in recent years, big mining companies turned toward dividends as a way to reward their shareholders. They turned more so toward dividends as a way to reward their shareholders, and frankly themselves as big equity holders. So that is a characteristic that's kind of lingering from the bear market environment. And it's in place now as margins expand and free cash flow expands. You're right, that's a new factor, a relatively new factor in the mining market that we haven't seen as much in past cycles.
But it sounds like you've got an element of skepticism in that, because I think people investing the resource space and in mining equities, don't they want growth?
You don't get growth in mining equities, unfortunately. It's more of a timing investment. You get growth in production, but you see that a lot of the number of the large mining companies have merged, and with that comes share dilution. And over the years, you have share dilution. So it's a different market than we had in the last cycle or the cycles before that, in that a lot of the mining companies aren't quite as leveraged as they were before because of the share dilution. You look at some of the largest mining companies, and their share prices aren't at the highs they were at 20 years ago. So you don't get the same kind of growth in mining stocks, at least from the capital appreciation standpoint, that you do in other sectors. It's more of, for the generalist investor, a way to time the macro picture, and that when you see an uptrend developing in the commodities and the metals, this is a way to leverage that trend.
Well, one thing that can generate investor excitement in the space is M&As, mergers and acquisitions, and over the past few weeks and months, we've seen an increasing number of deals happening. Are there any particular deals that you've liked or surprised you?
Disappointed me perhaps because we're not seeing the kinds of deals that create the kinds of rewards we invest in the sector for. You're talking about companies in mid-tier junior that might get taken out for a 15 or 20% price premium. It's more of a preparing for the future, merging forces kind of a thing. You are not getting the kind of bidding wars by the majors for the junior or even mid-tier sector that we would like to see. I think that's still to come. I hope that's still to come, but that's really what we're in this game for, is those kinds of takeouts, where you see an announcement and you see another company come in and up that bid and you get the bidding war going on. The smart companies, at least on the junior end, the explorers and developers, are developing their projects and have been developing their projects with an eye toward creating themselves as the natural other bidder. That if they don't get a good bid from a big mining company, the kind of takeout that they're hoping for, then they'll just try to develop it themselves. It's usually a bluff, but it has to be, for the junior standpoint, a credible bluff.
Now, Barrick Gold CEO Mark Bristow has famously said that he won't pay a premium in an M&A transaction. Obviously, he's a big voice in the sector. So has that potentially created a mindset that affects other companies? He won't pay a premium, so the boards of other companies say, well, why should we? We're not getting into a bidding war because of that on any given asset. Is there perhaps evidence of that?
Not really. Mark's a bit of an outlier, I think, among mining management. He wants his projects to make money at a far lower operating cost. It's not always developed that way, but I think he strikes a harder line than most mining executives. If they don't pay up for assets, they're going to get left in the dust by the other companies that will. I think there's still enough competition left in the market, even if Barrick stays on the sidelines, to drive premiums higher. But this is interesting. Barrick's interest in copper, when Mark has typically been somewhat of a gold-oriented investor, even a gold bug throughout his history for Randgold and then to Barrick. But Barrick's moving more into copper now, and I think that's another powerful story that's moving alongside the monetary story for gold and silver. It's an interesting time in the markets. It really is, in that we have two major secular trends that are very powerful but distinct in two closely related metals.
Now, it's not just Barrick Gold that's after more copper. Newmont, its deal with Newcrest Mining, a key factor there was greater exposure to copper. Are we looking at an erosion of the gold premium on the equities?
I think perhaps temporarily. Copper is viewed in some sectors as more of a sure bet. I think there's still a bit of a view in some sectors that gold's more of a fringe investment. But it's an interesting time. We saw the World Bank come up with an extensive report on gold, which we've never seen before. Very positive report, very well done. Hit all of the right factors from my standpoint as a gold bug. They hit all the right factors for investing in gold. And so that, if you look at it, that's a great report coming from the World Bank. But I look at it as more of an event. Why now? Why did that come out now? And why are we seeing central banks moving into gold at such a degree? I think we have to look at the sector and realize that there's something going on there. Gold has gained more respectability, and I think as this price rally continues and as smart money continues to invest in the sector, we're going to see that increase.
Okay, we've talked a lot about M&A. Is there a deal that you'd like to see happen? And if so, why?
I'd like to see every company in my personal portfolio sell for a ridiculously high premium. Tomorrow would do for that. One of the interesting things we've seen in recent years is a number of the bigger figures, typically good friends of mine in the junior mining sector, talk about how the big mining giants have wasted shareholder capital and how they really need get their acts together and stop spending money like drunken sailors. And my reaction to that is, why? If we're investing in the junior sector, we want them to spend like drunken sailors. We want them to pay ridiculous premiums for these juniors that we're holding in our portfolio. That's happened in the past. I think given human nature, it's going to happen again. So we should really hope for that if we're investing in that lower end of the sector. It's happened every time before, and I think therefore it's likely to happen again.
Okay. Brien, how do you think the rest of the year is going to play out?
I think that gold really did get ahead of itself. I think it's due for a correction, or at least spending some time around current levels to work off that kind of speculative excess. But you still see money coming into the sector on almost a programmatic basis. It just keeps coming in, which implies central bank buying and the like, and big institutions. So I think we're still going to see that. I think we've got that catalyst of the pivot still ahead. So my general view is we're probably going to be in what is, in reality, a fairly tight trading range of a couple $100, which in the past was not a tight trading range at all, but somewhere between 22 and 2,400 for some period of time until we get that Fed pivot. But the risk of a surprise in gold, I think, is to the upside and not to the downside.
Well, that's only a sort of 10% swing, isn't it? So
yeah, it really is.
That much volatility.
And if we look back in the 2000s and even further back in those other bull markets, it was not unusual for gold to go up 15% in a year. And we're talking about $300 price swings at these levels. So that's significant.
Excellent. Well, Brien, thank you very much for joining us today.
Great to be with you as always.
I'm Paul Harris, and this is Kitco Mining. Kitco Mining's special coverage of the Deutsche Goldmesse is brought to you by Dynacor.